All right. Hey, good morning, everybody. Happy Monday morning to you all. We are here getting ready to kick off. It's hopefully going to be another great week. And just wanted to kind of do our regular little market update. Just kind of let you guys know what's going on, what we're seeing, Portland, nationally, locally, so on and so forth. So, with that, thank God we're looking outside and the smoke is gone. The fire's somewhat under control, but at least for now, at least the smoke is gone and we can breathe. So hopefully everybody got outside this weekend and enjoyed some of the beautiful sunshine and fresh air. So let's go ahead and just jump right in. A couple comical ones to start off here. So kind of the usual. Hey Jeff, how's the market? Well, not a big shock. Way down last week. 25% drop in the lockbox activity. And by that, the lockboxes, that's essentially every time Jeannie and I go and unlock a door, show clients a house, it registers as a hit. So down 25%. You can probably guess why. Smoke, fires, evacuations, pandalarium. So yeah, it was down and not a big shock. So my guess is we'll see that pop back up during this coming week, but you know, see what happens, right? So that was Oregon, Washington, pretty much same thing, down 11%. So down, not down as bad. So I don't know if their air quality was just better, or if they're more resilient, or uh, if they're just a little bit more stubborn than we are on this side of the river. But who knows? But yeah, in both cases, things were down over the past week, due largely to all that. Now that said, we said some of the good news here was that the fires and the smoke are all gone. The bigger good news, if you have not seen this in the news already, if you've not, then fantastic. This is a good week to be tuning into this broadcast. If you've already read it, we're going to talk about it and kind of debunk some stuff here real quick. So big news from last week. The Fed announced basically, hey, we're going to sit tight on rates. They put out a forecast that shows no rate increases on the overnight funds that the Fed charges. So you saw basically we're going to keep it near 0%, and we'll talk about what that means for mortgages. But the Fed basically saying we're going to keep things flat probably through the end of 2023. So we got 3 years of what's going to be low rates. Now, I know a lot of people ask the question, I'm like, great. So if the rates are going to be zero, my mortgage rates, we'll start seeing things head towards zero, right? And no, sadly not. I wish that was the case. We all wish that was the case. What it does mean, though, is we're going to see sort of that indirect pressure, if you will, because of the Fed making this decision. You can expect to see rates, mortgage rates, stay probably roughly where they're at now, and within sort of just a general range of ridiculously low, probably for the next 3 years. So everybody kind of, the question always comes up on that. If the Fed's saying the rates are going to be, zero, or we're not going to raise anything, why is that not the mortgage rate? Well, and so mortgages are tied to 10-year Treasury notes, which are not governed by what the Fed's doing. What it will impact the mortgage rates more directly is what else is the Fed doing, right? So you had parts of the and part of it is keeping the rates low. The bigger part, that's an eye chart. Sorry. Basically, as part of their announcement of keeping the rates low, they also are reaffirming their commitment to purchasing mortgage-backed securities. So basically, what they're saying is they're going to continue to provide that liquidity to keep mortgages moving within the secondary markets. So what we're going to see now is because of that, plus the low, kind of near 0% for long-term horizon, that's what's going to keep your mortgage rates super, super low. You're going to see normal volatility kind of up, down, within some amount of deviation of, where we're talking, quarter point, half point, and it could be up, could be down, could be sideways. Bottom line is rates have been low for a long time now, and they're going to stay low probably for the next 3 years. So that's sort of a good news, bad news, depending how you want to look at it. It's good news in the sense of if you're waiting to do a refinance on your existing mortgage, maybe you're waiting to get your mortgage balance paid down a little bit more. Maybe you're waiting to you're just waiting, so you've got time, right? The other good news then is if you're feeling pressure of, hey, I want to buy a house because the rates are low, I want to take advantage of it, but I'm not quite ready yet. You've got time. The rates aren't going to be popping up anytime soon for the next few years, so you've got time there. The downside to that strategy, though, is with rates being this low, we're going to continue to see the market activity spiking like it's been doing for the last few months now. Property values are blowing up left and right because we're fairly constrained on inventory. No clear path to see an increase in available inventory via new construction around here. So, we're going to just kind of see what happens. So, yeah, you can sit and wait, but you can also continue to see headlines like this of home price appreciation is highest level since 2018. So what I think you're going to start seeing going forward month after month is, we're at the highest level since the last highest level. We're just going to keep that march. People are predicting next year. They're talking about seeing the secondary bullet point, if you can read it there. The price growth will slow through 2021, but remain positive. So yeah, so you're going to say, hey, the market's cooling off. Everything's cooling off. All that's going to mean is instead of seeing 10, 11, 13% growth in property values, maybe it's only 4, 5, 6, 3, 9. It's still going to be positive. It's just not going to be what it is now, which makes sense. Things aren't going to go up for forever. They're not going to go up at this rate for forever. Simply because if nothing else, you've got affordability issues. We do still have a little bit of a pandemic going on, so that's going to be headwinds for quite a while, probably at least a year or two. So, that's popping up. So yeah, the rates are still going great. Secondary, that report that they made comment about, we had a momentary COVID-19 induced blip, which I love. It's a momentary blip. And if you've watched these broadcasts, you've seen me show things before where it shows literally we had about a 2-month hiccup in the housing market. And then it's been, I don't want to use brush fire analogy. It doesn't seem quite right now, but it's been crazy ever since. So demand has definitely picked up. Driven by the low rates. You've got the millennials have entered the market. They want home ownership. So certainly if they're in more concentrated areas, apartments, downtown areas where they're around a lot of people, they realize maybe probably not the best place to be. Let's get some more distance, some proximity. I can live wherever. Plus, then you also have investors that are buying things up. And with the investors, it's kind of the interesting one, right? Because the values are going crazy, they're just ballistically going north. So there's a lot of good return opportunities, whether you're talking flippers or buy and hold rental market and so forth, because of the constrained inventory. And I tried to find a slide that would show this. Think of kind of Maslow's hierarchy of needs. One of the things on there, I think it's probably the second or third tier up, is essentially shelter, right? We all need it. We all want it. You have to have it. And in Portland, I just share that because here we've got the urban growth boundary. We are constrained on the inventory. Everybody needs it. More and more people are wanting it. Supply, demand, it's just going to kind of create kind of general craziness. And that last little comment down below, it's foresee a healthy housing market for years to come, which pretty much is a fancy way of saying if you own a home, you're going to be making money on that home. If you're a first-time buyer thinking about getting into home ownership, and you're thinking it as a way of a financial strategy to build wealth for yourself, you're dead on the money. That's a solid bet to be making right now for quote-unquote years to come. So even if you're buying a house, you think, it's a nice house. I mean, it's great, nice area, it's the right house. I don't know that I want to own it for the rest of my life. Don't. You probably just buy that thing for a few years and sell it and probably make a tidy little profit. Probably, depending on where you're buying. I want to show that this is another thing that kind of popped up, just showing kind of the severity of the decline in available inventory on real estate listings across the nation. And there's a handful of the dark red states, and of course Oregon is one of them. Our listings are down more than 30%. There's just not enough houses. So thus we're also seeing our prices just going absolutely crazy in this part of the country. So a couple, just last couple of points, and this one sort of ties back to the buyers here a little bit. So home builder sentiment is like it's its highest level in like 35 years, which I think is the longest time they've been recording it. They have some sort of an index that I guess typically, if the index is in the 60s, then it basically means home builders feel good about things. And I think that's kind of, also denotes sort of the high point of where the things have ever been, maybe 67, 69%. And it's currently in the 80s. So home builders are loving what they're seeing right now. They want to be building. And they know they've got all the right pieces in place. They're just now trying to find the land, the materials, the people. The buyers are not the problem, that is for sure. But we've got lumber prices are up. And I've shared this once before in this article, or these headlines keep popping back up. Whether it's tariffs or overall lumber supply, the prices of raw lumber is up. I forget the exact percentage, but it's triple digit, maybe quadruple digit, to the point now where just from the increased lumber prices for your average average family size home in the country, lumber price increases are adding an additional $16,000 to $17,000 to the price of a new house, just because of whether it's the tariffs, the supply. So nothing that you can really do about that other than you can produce more. Now let's go full circle here. You just produce more lumber, right? No problem, other than COVID. So now you have to kind of limit the number of people in any kind of setting that can be close to each other. And then what did we just see in the Pacific Northwest, where a lot of lumber is coming out of? Fires. So we are waiting still to hear to what extent Weyerhaeuser and some of these others have lost viable trees to the fires, and also to some extent some of their processing mills. How much fire damage did they sustain? Are the work crews, how many of those have been displaced from the fires and thus now not available to work? Don't know. So I think the lumber price part is probably going to maybe not be worse, but I don't see a lot on the headlines that are going to offer any kind of relief for where we're coming up for there. So stay tuned on that one. Just another bright spot on the fire disasters of last week. So hopefully that gets better here pretty soon. And then the last thing I just want to share, this kind of popped up. It's just sort of interesting. People talk about kind of HR policies related to COVID type stuff. So, whether you're going to allow for more work hour flexibilities, more work location flexibilities, and then the last one just with the sick coverage and stuff. But the second that middle bar, how many are going to allow for more work location flexibility? 63%. And then if you look on average, 43% of those executives expect that change to last 6 months or permanently. So I think we're going to see a societal shift of a lot of companies are now recognizing we don't have to have big offices. We don't need people sitting right here next to each other to be productive for a lot of what we do professionally. We've got Zoom, we've got broadband internet, we've got the ability now to work from home, work remotely, work, however you want to work. I think it's going to make more of a push for homes, especially those that are a little bit bigger, that can sustain a proper home office, possibly those that can support dual home offices so that both spouses can be home working. So do you have a home office space? If not, you're probably looking for another house. Thus more pressure on the already constrained inventory. And like we talked about before, if you've got a house with a dedicated home office, get a nice little tax write-off as well. So if it's just your dining room table, don't try to write that one off. You're going to regret that decision. So there you go. That's your market recap. The biggest thing that's happened in the past week is the Fed decision to keep rates at zero for at least the next 3 years. This market has been crazy for months. It's going to stay crazy probably for years now. So buckle up. It should be fun to watch, see what happens. Again, glad everybody's hopefully staying safe through the fires. Glad the smoke is gone. And if you have any questions, feel free to let us know. Either comment on this broadcast page, shoot us an email, text, or otherwise, and we'd be happy to talk. Have a great week, and we'll talk to you soon.